Oh man, is it really Wednesday again already?
Time flies when you're having fun.
It sure does. Hey everyone, welcome aboard the Humpday train. I'm Matt Robinson.
And I'm Woody Walden, and this is your
Humpday Update, where we bring you real estate news hot off the presses to help you run a smart real estate business, which is
stress-free,
money and credit-free,
asset-free,
risk-free,
and tax-free investing strategies that work right now in this market.
Which market?
This market.
So you're not talking about the market from 5 years ago that has nothing to do with today?
Oh no, we keep it fresh and current here at the Humpday Update.
That's what I'm talking about. Okay, Woody, so the S&P Case Schiller report on home values was recently released, and they reported that home prices are dangerously close to an official double dip.
What are you doing? What? Did you just double dip that chip? Excuse me? You double dipped the chip. Double dipped? What are you talking about? You dipped the chip, you took a bite, and you dipped again.
According to Capital Economics, the second leg of the U.S. housing downturn will continue throughout the year and could be nasty if a vicious circle of falling prices and rising foreclosures continues.
A senior economist at Capital Economics, Paul Dales, said that the second downward leg in the housing prices that began last year will continue throughout the year and take prices to a new cycle low, some 5% below current levels.
Now, in the hearts and minds of some lesser folks, this news might seem discouraging. But we've been around this business long enough to know that in this situation, you need to listen to my life coach.
There is just news. There is no good or bad.
That's right, man. Because Mr. Dales went on to say that with well over 5 million homes either up for sale or in foreclosure, the rental market could be very strong. After all, the fact that the rental demand is rising, the rental supply is already tight, means that for the next few years, the rental market will be the best performing part of the residential market, which is music to many investors' ears.
That's right, and additionally, a further drop in home prices will certainly increase foreclosures, which has been a big profit center for some savvy investors for the past few years. In the U.S., 25% of households have negative equity, and another 25% don't have enough equity to refinance. Another drop in values could send many homeowners packing as they fall further underwater, searching out an investor to help them unload the property. Lori Goodman of Amherst Mortgage Securities affirms this fact, stating that home equity is the single most important determinant of mortgage default, not unemployment.
Zillow's chief economist, Stan Humphries, agrees with Ms. Goodman, stating in a recent interview, once you get above 125 to 130% loan-to-value ratios, that means you're 25 to 30% underwater on your house. At that point, you really start to see a higher rate of strategic default as people feel a sense of futility about making their mortgage payments.
That's a great point, Woody. And the third potential benefit to falling home prices is that home affordability continues to rise. In fact, home affordability is the best it's been in over 8 years. And Trulia just released a report showing that it's cheaper to buy a home rather than renting in 72% of U.S. cities.
Wow.
This is a stat you should really consider using in your marketing to help get buyers off the fence and looking at your rehabs or investment properties for sale.
In our consumer warning segment for this week, we'd like to talk about some of the inconsistencies of the housing data that is being reported from all these so-called expert agencies. It seems as if everyone and their brother is coming out with housing data, oftentimes conflicting with one another, which makes it really difficult to know just which one can you trust.
That's right, and this problem really went under the spotlight recently when CoreLogic, another one of these many housing data providers, claimed that the National Association of Realtors had overstated home sales in 2010 by 1.5 million. And now that could be just a little bit of a problem.
Now, of course, NAR and others have come out to call that figure overblown. But the realtors themselves have admitted that there's a problem. They are now re-benchmarking their sales calculation process. Whatever that means. Apparently the last time they re-benchmarked was over a decade ago during the 2000 census.
Well, just a decade, that's it. Walter Maloney from the National Association of Realtors says that they are consulting with various outside housing economists, government agencies, and some academic experts on the methodology to determine if there is a problem with their calculations.
Wow. However, inquiring minds would like to know why NAR would wait until someone called them out before taking a look at a decade-old benchmarking process. We're certainly not insinuating that they would purposely report some false data on home sales, but they would certainly have a reason to turn a blind eye if their numbers were somewhat inflated.
Yeah, they certainly would. You see, NAR wants to influence public opinion as much as possible and has always been in the business of putting positive spin on housing news. Why? Well, because if people aren't confident, they don't buy houses.
Right.
If they don't buy houses, there isn't enough business going around to support all those realtors.
Right.
And if realtors drop out of business, they stop paying NAR those millions of dollars in annual dues. Makes sense, huh?
So the moral of the story is to make sure you consider the source when you're reading housing data, especially if you're going to make an investment decision based on that data. If you're trying to determine the value of a house, you don't just check the Zillow estimate on Zillow. You call a realtor, maybe you talk to an appraiser, and check the county website for recent sales as well.
Right, and in the same way, you should research multiple sources of real estate data. Consider how each one is reporting and analyzing that data, and make sure that you're making informed decisions with your money and your real estate investments.
Thanks again for joining us for this week's episode of the Humpday Update. Check out new episodes every Wednesday morning at humpdayupdate.com, or you can get our videos sent directly to your phone each week by texting the word Humpday to the number 90210.
And do us a huge favor, forward this to your friends, post it to your Facebook, and embed it right into your own blog.
And subscribe to our YouTube channel by clicking that green box right down there.
And from all of us here at the Humpday Update, which I guess is just you and I, have a prosperous and productive rest of your week, and as always,
Finish strong.